It's a webinar. I'm Paul Rickard and I'll be joined today by Peter Switzer. How are you, Peter?
I've got to say, it's nice to see you doing all the hard work. Yeah, on TV, I'm always doing the hard work. It's good to see you do it, Paul.
Right, okay. Well, well, I'm pretty well too. It's 12:30 p.m. just after in Sydney. We'll, as always with these webinars, we aim to finish by 1:30 Sydney time. So we know a lot of you have got other things to do and are busy people. So if you're thinking about planning the time, we'll make sure we finish no later than 1:30 p.m. in Sydney time. Secondly, I've got to start with the obligatory disclaimer. Of course, Peter and I don't know anything about your particular needs, financial situation, or investment objectives. So any of the comments that we're going to be making today, of course, are general in nature, may or may not be suitable to you, and if in any doubt, then you should seek appropriate professional financial advice before acting on any of the things that we say. So with that disclaimer out of the way, one other housekeeping matter that I'll just get to. Of course, this is an interactive webinar. We have some questions already, but really we want your questions as we go. So you can send in those during the webinar by using the question box, which should be towards the bottom right-hand part of your screen. And Bernadette will try to come to you to see whether you want to ask your question. We'll unmute you. If you can't, don't have a microphone, or Andy will ask the question for you. But also, finally, to close other applications if you can, and please ensure that the volume of your computer and speaker level is okay. So let's move ahead as we always do, Peter, by start with some opening observations. And I just want to go to what my one of my usual sort of favourite charts, Peter, is, if Bernadette, if you can move that forward, is just to look at what actually happened in February, what's happened on a year-to-date basis. So I think that the key take is the market, as we all know, is up over 10%. If you put dividends, 10.4% over 2 months, very rapid since about 15th or 16th of January. The other highlight that all sectors in the green, which is a little unusual. Not a huge disparity. It may look like there's big gaps there, but that's actually a reasonably tight field at the moment. And I think in February we saw the bounce back of material stocks, and those notably BHP and Rio following their reports. Energy on the back of oil prices, and probably the downward part of February was consumer staples really hit by Woolworths. So, Peter, any comments on what we saw in the month of February and come to earnings season in the
Okay. There are a couple of big forces explaining the green on the screen, as we say in TV land. One, of course, is the fact that the dollar has come down and helped a lot of the companies that you and I have talked about. I used to talk about, ask the question, when are the smaller companies, the non-dividend paying companies, the cyclical companies, going to play catch up? The dollar coming down has helped, definitely.
And they did do a little bit of catch up in February.
Yep. And you made a point in a TV thing we did for NABTrade that the smalls have done well. Was it 8%?
Yeah, the small orders, which is stocks number 101 to 300.
Yeah.
They're a lot smaller than them, but these are sort of still by market standards. They're not micro caps, but they're smaller caps. In the month of February, they put on 8.4% compared to the top 20, I think, put on 6.2%. So it showed that in February, at least, that there was a bit more interest in some of the smaller companies.
Yep. So I like that. I think the Reserve Bank is another important thing. Without Reserve Bank, we wouldn't have kicked like we did. And if they'd cut last Tuesday, we would have gone over 6,000 without a doubt. Remember, when they didn't cut, that market fell. So it's been an important part of the story for the stock market has been dollar down, petrol prices down, interest rates down, and actually, and people wonder why. Well, all those things help the economy in the future, not now. And we know the stock market always tries to anticipate the future.
Yeah.
So I think a lot of this is telling us that we will see a better economy in the future, despite the silly negative headlines we're seeing right now about ironically, the December quarter.
Yeah.
Because
that's all history, right?
That's all history. Yeah. So I think we're in that turning point of the economy. People know I wasn't necessarily a great fan of interest rate cuts until I saw what it did to the stock market, and I think the economy is a bit slower than I thought. I thought we were close to high 2s, low 3%. We're around 2.5. And it's the Reserve Bank's fault, and it's also the government's fault. The budget spooked consumers and business, and the dollar was too high for too long, because interest rates were too high. I think we're getting into a better situation, and the stock market is reflecting it. I think we'll come down from here, Paul. I think.
Okay, well, let's come back to the moment. I want to come back
to
a little. Yeah, well, that's what's going to keep the show moving, Peter.
Okay.
And I want to come back to a little comment we had off there a minute ago about we just got to just under 6,000 on Tuesday it was.
Yeah.
Let's just go back to earnings season. Highlights and lowlights as far as you're concerned.
Well, the earnings season wasn't unbelievably impressive, but about 70% of companies actually beat on their profit expectations. And I've got to say, and I feel a bit guilty about this, some of my experts on my television show have written earnings season off. But that's an important number. Around, I think it was 69, wasn't it, Paul? About 69% actually did beat on profit expectations. And even though the size of the increase in earnings wasn't as big as we would like, what was the increase? Was it 3% or something?
Yeah, I think so, yeah.
I think the hope was we might have seen 6 or 8. I think it's a good sign that companies, say 69%, have actually beat. I'll actually check that number up when you do a bit of a rave, Paul. But generally, earnings wasn't as good as we'd like. Remember, it comes from the December quarter, and the December quarter only grew at 0.5%. If we were living in America, I'd multiply that by 4 and say it's a 2% quarter, annualised. So to get even 69% of companies beating on expectations, that's not bad considering the economy. So that's my take on that.
Okay, highlights? Any
for sure. You and I stuck our necks out and saying at those ridiculous prices, VHP, they look like a buy, and they've delivered. You're a little bit more negative on VHP in terms of pumping out so much output.
I'm just negative. I think that they're both. I'm not sure they've really thought through what would happen if they actually did not raise production and actually cut production back a little bit. Whether that may actually be a better long-term outcome. They seem to be hell-bent on increasing production, driving out the high-cost producers, in particular out of China.
Yeah.
And it's like game theory. Do you smash out more production to drive out the high-cost people in the expectation that one day they'll leave the market and prices will go back up?
Yeah.
And in the short term maximise revenue, or do you withhold production and basically let hope prices rise? And it's a question of what's the best outcome for shareholders. I'm just not convinced that the current strategy just to keep on pumping it out from Port Hedland at light speed is actually the best call.
No, and I guess that's the important part about the earnings season. The report was better than we expected, and the stock market has reacted well. I also think I'm glad to see that dividend-paying stocks are still delivering to the market, but they were helped. Let's take their earnings in isolation and look at them and ask the question, if the Reserve Bank hadn't cut interest rates, would those earnings compared to where interest rates were, wouldn't have been quite as good. But the fact that the Reserve Bank has cut interest rates, put the whole earnings story together, you can buy those stocks and the PE compared to what you get interest rates makes them buyable. So that's been another thing as well. So the Reserve Bank, in a sense, helped the calibre of the earnings.
Okay, well, we're going to come back to a low light, I think, from Woolworths. I know we've got a question on that, but I just want to wrap up this session. Okay, so today we're off a little bit. We got to 5,996 points.
We were 3.9 points.
Okay, I didn't want to undersell your call of 6,000.
3.1 or 3.9.
Yeah, so we got to 5,996.1 on Tuesday, just before the Reserve Bank didn't cut rates. Okay. We've come off a bit since then.
Well, I guess I've been teasing with the bank. They want to get even with me.
Yeah. So the question is, Peter, is this Are we due for a pullback, or is this just a little temporary sort of slowdown and we've got more momentum to come?
Look, I don't know how far we will come back. I think we're in a bit of a pullback mode. Remember, once earnings season's out of the way, you need significant economic stories or significant geopolitical stories to give the market a kick along. Now, of course, on Saturday morning, we'll see the jobs report out of the USA.
That could be a big one because people don't seem to be talking about it too much. Is that what worries me a little bit one way or the other? But
well, let's just be clear on this. If the number's better than expected, the market's going to say the Fed could raise interest rates earlier than expected. And that could be a test for the market. The US market could actually sell off on that news. And most of the people I respect think when the numbers are so good that everyone says the Fed cannot afford to delay any longer, the market could actually test current levels. Because if you look at Dow's all-time high, S&P all-time high area, and the NASDAQ
cross 5,000?
Yeah, cross 5,000. Its highest ever was 5,048. So that's not far away. So I think I wouldn't be surprised to see it sell off. I think I provided a chart in one of my reports recently where I show US profits have come down a little bit. But that also is over the quarter, which was a slow quarter. And the cold weather was a part of the story there as well.
I just think it's been very quiet there, and there are a few expectations of a weaker number because some of the earlier data suggested that February might have been a little quieter.
Okay.
I'm just worried about that. There's just sort of it's gone a bit quiet in the US, and you always wonder when the markets go quiet. There's something around the corner. So
of course, remember, there's been good news coming out of Europe.
Good news, yeah.
And my argument still, my argument still holds water. Okay. If I do sell off, I'm a bit quiet.
So bottom line, notwithstanding that we've got a big number in the US tonight, that'll be about 11:30 p.m. our time, I think, from memory.
Yeah. We see it in the morning.
We'll see it in the morning. We're both probably in the school that the market needs a little bit of a breather at these levels. So, we've been, that's where we are at the moment. You're thinking?
Look, if two things happen, a massive number in the US, and the Fed still came out and said, we're not going to cut until 2016, the market would go sky high. So that's the sort of situation.
Okay, you can read all about that tomorrow in Saturday's regular Switzer Super Report. That'll be obviously be...
I love getting up at 5 o'clock.
You're good at that, Peter. Okay, so let's go to a couple of questions. I just want to go to the Woolworths question first, since it's just a bit topical. Okay, so just go into that one first. This is the other wrap-up from the reporting season. And look, Woolworths was clearly a standout disappointment. There's a bit more press today. You might have seen my article in Switzer Daily yesterday about Woolworths. I think Woolworths is going to be attractive buying for the yield players around these sort of levels, maybe a bit lower down. But I don't think we're going to see a lot of growth in Woolworths. I think there's a couple of things you've got to be cognizant of. Firstly, the market has got really lost confidence in Woolworths management, and that won't be easily won back. So when markets do that, they take a negative view on stocks. The analysts take quite a while to turn around. That's factor number one. Yeah. Factor number two is the short sellers are quite active now in Woolworths, over 5%, which is pretty big for a top 10 company.
Yeah.
More often than not, they get it right rather than getting it wrong. So that's going to limit gains. And thirdly, what Woolworths had to say, if you read the bottom line, was that they've misjudged the market. They've lost share to Coles. They're worried about their market share. They've got their pricing strategy wrong.
Yeah,
so we're going to cut prices, to win back market share. And that's not always a great problem. So I think the way they've got a strategy day coming up, I think it's in May, and the market's really not going to do anything in May. If our market rallies hard from this level, Woolworths shares will lag. I think that's
they'll be dragged along.
They'll be dragged along, right? So you'll get better also. Background $28, $27. There's some value in there's a yield stock that just popped over $30 today.
You're going to sell your Woolworths?
I'm not selling them, but I'm just not. I just don't think.
You're not double.
I'm not double dipping. And I must admit, the more I looked at their numbers, the more disappointed I became.
I've got some good news on Woolworths when you eventually finish scaring the pants.
Yeah. So look, I'm not selling. Like I don't do a lot with my own portfolio. I find it so hard to pick tops and bottoms.
Yeah.
But I'm not bailing. I bought some Woolworths shares at these levels about a month ago when I thought they were of value.
Yeah.
On the back of that news, 29.70, 29.80 doesn't do it for me at the moment. And maybe a big figure. I think in $28 type level, I would look again. But I'm not bailing. I'm not jumping in at these levels.
Okay. Let me say this. I'm with you. If I saw 27, 28, I'd probably buy to just reduce my overall holding cost. I think they'll come good. It might take time. The guy that put in with the supermarket,
He's a good guy. Brad
Banducci, yeah.
Yep.
He ran down Murphy,
Yep.
and I've had a number of conferences with him. Very smart guy.
I know Brad. I think he's a really good operator. And they got the other guy that had to go.
Yes, right. And the people that got rid of, some people tell me, good moves.
Yeah.
I also think that the Masters thing has been a nightmare. But I do think the Masters thing doesn't have to be Bunnings. It probably will be at Mitre 10 and all the other small hardware people as well. But it hasn't been a great story for them. I know they've got a strategy where they're actually introducing really small Woolworths. Like, for example, they're putting a Woolworths in Queen Street Alone, a small one. Yeah, and it's not a very... So that could be an interesting strategy where they pick up high net worth areas where people aren't price conscious. That's interesting because, people in Queen Street get ripped off all the time because they love the convenience of being in Queen Street. So there could be some good things happening there as well. But once again, I'm with you. I think it'll be dragged along if the market goes up. The dividend, not bad, but they're not going to really knock the socks off. But Banducci is a good appointment.
Good appointment. So the jury's out, but I wouldn't be rushing in. And I think, again, good weakness. Might be a stock having a look at. As I said, I don't sell them simply because, stocks that yield near 5% and have a history of paying good dividends, notwithstanding that, I sell them.
And they're recession-proof businesses.
It's a reasonably recession-proof business, right? So, look, why sell it? I just can't.
The interesting thing...
Would I if I'm massively overweight, would I change weighting? Possibly, but,
I'll give you a slightly crazy aspect to the way I invest as well. I'm a realist. I know somewhere along the line over the next 3 or 5 years there will be another market crash. And when the market crashes, a stock like Woolworths becomes really viable at, say, 18 or 19 when the market's being really ridiculous. And so having them in my portfolio, I'm not okay.
Okay. Look, how do we buy foreign shares? I'll just do this question before we come to yours from Sarah. How do we buy foreign shares through the SMSF? I'm not sure. I think that means how can you buy foreign shares. I think if I interpret the question properly, Sarah, there are a number of ways. Just go back to Sarah's question. All right, okay. I'm just, sorry.
Bossing Bernadette.
I'm bossing Bernadette's doing a great job.
But she's one step ahead of Paul.
She's one step ahead of me. So it was coming back before I even said it. So look, there are about 3 or 4 ways to buy foreign shares. The easiest way is through a managed fund or an ETF. Probably an ETF is the best way to do it because it's cheapest, you don't have to worry about it. A lot of ETFs listed on the market, from iShares and the Vanguard in particular are probably the 2 leading providers, State Street. So that's number 1. Number 2, you can look at some of the specialist managers, people like Magellan, Platinum are probably the key standouts at the moment. They've both got websites you can look at the funds. Number 3 is you can actually buy foreign shares directly. You'll need to open an account. ComSec opens an account, has a facility. E-Trade has a facility. I believe NAB's about to have a facility, Peter.
Yep.
And if you want to go and buy Apple or Google or something else, that's the way to do it. Facebook or something out of the UK, you can do it. So there's probably the 3 ways: ETFs, managed funds, or thirdly buy shares directly and go to one of the major brokers who can help you there. And probably the second question is probably more important. I mean, the dollar's already dropped, so we're down to 78 cents. Is it too late? I think is really what it, and where the market is, Peter, is it too late to buy American shares now, do you think?
Well, put it this way.
We were at $1.10, right?
Yeah.
And we're down to 78 cents.
And
the US market was a lot lower when we were at $1.10.
And we were strong advocates of having exposure to the US stock market when our currency was high. Put it this way, I think the Aussie dollar is going to go a bit lower. The Reserve Bank wants it to happen. We need it to happen for the economy. And everyone thinks there's another interest rate cut, maybe even 2 out there. That will bring the dollar down. I also think the greenback will go up. So that means if the greenback goes up, it will drive the Aussie dollar down as well. So it's not too late. It's just that you won't get as big a bang for your buck as when the currency was averaging 95, spiking at 110. So that's my view on the US market. You still can make money. There will be exchange rate. It's when we think the Aussie dollar is at the low point that's the scariest time to buy, because I know there was a time in my life where I picked the NASDAQ brilliantly, but the Aussie dollar went up really proportionately. It's an inexplicable relationship between the NASDAQ and the A dollar, and it was cancelling my brilliant stock market observations. So because I think the dollar will go down, I think there's still a bit of American benefit.
And of course, there is, look, I won't go into some of the arguments about hedging or unhedging, but there is, you can, of course, some of the funds out there are hedge funds, that is, so they're not exchange rate dependent, so the manager will hedge it out. That actually works for you, you get a bit of a benefit in doing that.
Not to be like the returns, but it makes it safe in terms of those big moves, doesn't it?
Yeah. So, will generally work for you because of the interest rate differential. So, you can actually find the funds that are hedged. In other words, so just effectively you're investing in the US market, not investing in the exchange rate. So, you can look at that as an option. Okay, look, I just covered Woolworths. I noticed we've got a question from Barry. I just want to go to Barry just to see what I answered his question about Woolworths. So, we're just going to see if we can unmute you, sorry, Barry. And
Barry Burrow, are you there?
Yes.
Look, I addressed your question on Woolworths without seeing it. So, you think we'll cover what was your question about Woolworths?
I just wanted to know what was your opinion about Woolworths, but you've answered that.
Okay. All
yes.
Right. Well, if we've done that, we'll move on.
Thank you.
Okay. Thanks, Barry. Let's go back to Vicky. Vicky's got a question there. We're going to try to unmute you, Vicky.
Vicky Elbridge.
She's self-muted. Okay. This is a bit of a tricky question, so I actually did want to see whether she's self-muted. Okay, I'll have a go at reading it out, but it's sort of one of those. It's a $64 question.
Okay,
I think it's right up your alley.
Okay.
And it's a question a lot of people ask, and I understand exactly why this is top of mind for her. She says, I have a work-based super fund and wishing to retire within the next year or so.
Yeah.
I'm 58. But not sure how much super I will need and where to put my money. So I think she's thinking about how much she actually need to have in super, and when she takes it out, she leaves work, probably what she should do with it. So probably 2 parts to that question.
Yeah.
I think how much do you need is always a really good question, right?
Yeah. In simplistic terms, we often say a couple with $1 million when they retire in a reasonably comfortable position. But that was often based on the idea that we get 4 or 5% term deposits for a nice, safe 50 grand to live on. For an individual,
in fact, Barry Nuss wrote an article yesterday for us on that, saying if you were a fairly cautious investor and you're putting in term deposits, you had $1 million, you'd end up with 30,000, which is not really a lot, is it?
No, it's not. I think the best way of answering this, Paul, isn't it to work backwards? How much is Vicky, isn't it?
It's Vicky, yeah.
How much does Vicky need to live on? And so if she said, look, I might own my house, I want 30,000 plus, if I can make 40,000, that would be great. So remember, she possibly, if her sum's not really big, she could possibly get a part pension as well, right? So that factors in as
well, she will be when she gets to 67 potentially, yeah.
Yeah, okay. Well, that has to be worked in because part of her capital might be whittled down by that time. I would say if I was a single person and my house is paid off, I would feel comfortable if I had about $700,000.
Okay. I think, Vicky, look, we're probably going to leave it there because you can't actually, you can't get to the microphone. But look, I reckon those are the sort of questions that, I know we sort of conflicted saying this, Peter, but this is where you probably need to see a financial advisor.
Yeah.
There are some good financial advisors out there,
yeah.
and I think those sort of questions, how much do you need, where to put it when you're doing, do you own your own self-managed super fund or whatever, they're all things that you probably need to get advice on. I think.
Your goals are specific to you, your assets are, your liabilities, and someone has to help you work your way through it.
Okay, let's go to Ruth, if she's out there. This is
Ruth Bell, are you there? Ruth, we can hear you. Would you like to ask your question?
Hello, can you hear me?
Yes, Ruth.
Yes, I was just wondering for some advice if a major correction is coming up, how to set up your portfolio just to protect yourself.
Okay. You know, one of the best things you could do, see, ultimately it'd be fantastic if someone brilliant, like me, and then brilliant in very common, actually warns everybody, you know, a month or two before it all happens, Ruth. I hope I can do that, but you know, history says it's often not easy, but that's going to be my goal. But let's just imagine that the so-called brilliant person misses it. In a perfect world, you should set your portfolio up in the self-managed super fund. So you've got a buffer. Now imagine, just for simplicity, you have $1 million and you're averaging a return of about 5%. You might be getting 8% on your stocks, you might be getting 3% in your term deposits, but you're averaging about, say, 5%. It's pretty low ball, but let's say on $1 million, you'd be getting 50 grand in a year, and you'd be able to maintain your capital at $1 million because you're getting 50 in and you're spending 50. In a perfect world, in these good years when you're doing better than 5%, you know, we've been through some good years, you try to put away a buffer. You might build up a buffer of $100,000, which is 2 years of when the market might be down and the amount of money you're getting off your shares could be reduced. And I think that's the kind of thing I would be doing. Make sure your portfolio is made up of great dividend payers, because when the market goes down, it will go down by, say, 30%. But your dividends won't go down by 30%. They might go down by 10 or 15%, but you still can make up because you've got a buffer there, and that buffer is used. And during the good times, you try and build the buffer up. You might eventually turn your buffer into $200,000, and after time you might say, that's a very safe buffer, and you might take $50,000 of that buffer and buy some really good stocks. When a market falls, you might buy CBA at $50 rather than the current 90-something. That's the way I would be looking at for those times when the market crashes. Paul?
I think that's good advice, Peter. I think the other thing, if you want to prepare for a major correction, look, obviously you try to change your risk weighting and move your portfolio around from higher risky assets to less risky assets. Mm-hmm. And even in the stock market, you could start to look at so-called more defensive stocks rather than growth stocks. So, you know, look, we talk about, you know, what happens in the event of a crash. Generally, you know, what we find in a crash is that the top 20 moves harder initially, but they bounce back sooner.
Sure.
So, but stocks like, you know, some of the banks, Woolworths, Medibank, you know, some of the property funds, they're going to be less exposed to a big move down in a medium-term sense. So that's the other way. That's how I prepare for the really short. I start to take some profits and move back into cash and start to and bonds and start to reduce your growth asset component.
During the GFC, I was interviewed a lot on television and radio for obvious reasons. Everybody was scared. And I make the point that, you know, we've gone down a long way. I think we're down nearly 40% when these questions were asked for. And I said, well, there's going to be a bounce back. And when it does bounce back, it's usually very big. And people would say, well, what would you buy? And I just kept saying, buy the 4 banks, because they were AAA rated in those days. And the people who took that advice must have made a squeak.
Okay, let's go to a question from Michael, if we can.
Michael Coe, are you there? can hear you, Michael. Would you like to ask your question? I don't think Michael's listening.
Okay.
That's okay.
Some people might have trouble actually de-miking because they never...
Okay. Michael's got a question about BAL, which is Bellamy's. It's a company I don't know a lot about, but I see it's just made it.
They make chocolate cakes in America and stuff.
They make infant formula food and things like that.
Yeah.
They're just about to go into the ordinary, so they're becoming a top 500 stocks. The share price has gone from pretty impressive run from it's almost 50% up in the last 12 months.
Yeah, someone talked about it on my television show, and they've been a pretty impressive performer.
So look, I don't know enough about to comment on Bellamy's. I'm sorry, it's what I describe almost still a micro cap.
Well, what's the chart look like?
The chart looks good.
Yeah.
And so maybe Peter will take that on notice, Michael, and
I'll ask some people on my television show.
Some of the small cap guys like Jeff Wilson and others, what he thinks of it.
Yeah, for sure.
Okay, we've got a question here from Mary about BHP or Rio. Can we go to Mary?
Mary Walton, are you there? No, we don't have Mary either.
Okay, Mary's question is, what is a better buy, BHP or Rio? Good question.
That's a good question. Why not buy half and half? I think they're both good companies. BHP is more diversified, and Rio is primarily iron ore. And Rio has a company kind of stalking to a certain degree, Glencore, doesn't it, Paul? But I've got to say I do like the diversified nature of BHP. So that's my preference. I hold both, and I hold reasonable quantities of them. I bought them at good prices. But that's my view. I can't separate them easily, but I do like BHP's diversification.
Yeah, I'm in that school as well. I'm just telling you what mainly for diversification reasons.
The brokers seem to like Rio a bit better.
The brokers like Rio better. So at the moment, the brokers have got a target price of $72.99 on Rio and a sentiment ranking of 0.8, which is pretty close to everyone's strong buy.
Yeah.
And on BH, that $72.99 is about 20% away above current market price. Yeah. The BHP, they've got a rating of 0.4, it's not bad, but a target price of $35.45, which is only about 9% away from current market.
So Rio is the one more favoured by the brokers?
So the brokers, they favour Rio. I prefer BHP for diversification. Rio's got a share buyback at the moment, which is helping it. And I think it's a fair bit more to build in the Rio price because of the whole Glencore thing. I'm bearish on iron ore prices, and I think I prefer BHP to long-term better. But,
But doing 50-50 is not a bad one, Paul. They kind of move together.
They do kind of move together. Rio will generally be a little more volatile, and certainly sentiment on Rio in the last 12 months ago, certainly BHP was a better performer. Sentiment has been a lot more positive about Rio over the last 6 months, and that's probably why the brokers are more bullish. So look, it's hard to separate. You probably don't need both. I'll probably stay with BHP, but as Peter said, the brokers see it a little differently, so that's what the analysts do, and that's what they're paid to do. Okay, so can I go back to this question which we didn't have from No Mike from Frank? And Frank's got a question about Charter Hall, Peter. Which I think you mean for Charter Hall REIT, I think.
Yeah. I think they're a good company. I haven't looked at their share price recently. REITs have gone really, really hard. And you and I were kind of thinking REITs could start going off the boil, but because everyone's still chasing yield, they've done pretty well. No problem with the company, but I wouldn't be going mad chasing REITs at this point in time because I think they're pretty well priced.
Yeah, I'm on that view as well. I think they are pretty well priced, and it's been yield compression rather than some really huge recovery in the
Explain what yield compression is.
Yeah, so the yield compression is all about the valuation rates essentially used to look at how commercial properties are valued, and really being compressed because as interest rates go down, the rental returns on commercial properties look that much more attractive.
Yeah,
so,
yeah.
If a commercial property is yielding, 7 or 8%, and interest rates were at 5%, when interest rates go down to 2%, look, this 7 or 8% looks very, very attractive. So what happens is that 7 or 8% yield, rental yield, falls to, 5%. And that's really the compression, and that means the thing becomes more valuable in a pricing sense. So when interest rates go up, you're going to see the reverse. So it's really about, the yield that has driven the...
so Charter Hall could be good for another year, but when rates start to rise, it could come to a bit of pressure.
Yeah, and it's interesting. Look, I go back to that chart here. If you just go back to the first chart, maybe it does.
You want the sectors?
Yeah, they're still doing pretty well year to date, but even in February, it just lagged a little bit, which is 11.7% year to date is not bad, but you saw in February, if I just go back to that chart there, when the market put on a 6%, property trust started to lag.
Yeah.
And the stronger the market gets, property trusts will lag it going up. So good defensive stock. If you're very bullish in the market, probably not the place to play.
It's a quality company, but you don't have high expectations.
Yeah, absolutely. Okay, so let's go to Murray. We've probably covered some of this question already, but Murray's got a question around consumer staples.
Coming to you, Murray. Murray Boyd, are you there? Murray, are you there? We can hear you. Hello, Murray. Okay, no, he's not there.
Okay, I'm having trouble with you unmuting today, but anyhow. So, well, we unmute you, and then if you've got a microphone, most laptops have a microphone, you speak, or a built-in microphone, you should just be able to speak into it. Is that right, Bernard?
Okay,
So, so much about technology is
I always have people doing it for me, but still, okay, now we all know.
Okay. So when I say we unmute, we have to do it at our end.
Okay.
And, okay. So this is a question about the consumer staples sector. We've already sort of touched on this about Woolworths, Wesfarmers, and Metcash. And the question is, we are struggling with all the new entrants. So, sorry, Metcash, Woolworths, Wesfarmers are struggling with all the new entrants. What's their long-term future? So do you think these guys having to fight off the Aldis and the Costcos and the others?
Yeah, I think they're going to find it hard to get big growth in their share price because the market is becoming more competitive. If you look at their share price, maybe even over a 3-year period, Woolworths got as high as 37, didn't it?
Up to almost $39.
Yeah. It started off around 20, 29 on a 3-year basis. It's funny. It's about 29, so it's kind of near its 3-year low now.
Metcash is on the 3-year low.
Yeah.
You find
so it's rising from 29 to 39 is a big rise. Now, it's going to take them a while to get that kind of thing happening again, and I think the new rival will make it hard. But if they can go from 29, let's say 30, to 33, that's still a 10% gain in a pretty safe kind of business. That's what I'd be thinking of. You might only see a 10% rise in share price on a 1 or 2 year basis. Plus you throw in your dividend of about 3 or 4, you're still going to make about 9% on a pretty good company. What are you thinking about? That's what consumer staples kind of do.
Yeah, it should be a defensive stock. I mean, I've got to be honest and say I've changed my mind a little bit about this sector. I've made a call to be overweighted in my yield portfolio. I think that may be wrong in hindsight because I think the competition is probably going to be... You'll
make money, but not as much as you want.
It's making more inroads than I thought.
Yeah.
The only positive is the sector has got quite a lot cheaper. And I think that we're sort of in that stage now where I think they're going to be, you know, I'm going to say there's a price war about to happen, but I think what you started, if you read the Woolworths announcement closely, what that sort of signals is they're going to be a little aggressive on pricing. And that's going to be bad for margins. So, look, I think they're a little bit worried, and you know, that might be a little harder to get a great shareholder return out of Woolworths and Wesfarmers and Metcash over the next couple of years.
Yeah, and I guess the surprise package might be one day Masters might get it right, and then it'll all change. Then you might get a spike, but it might take them 3 years to do it.
Yeah. So I think the Australian market is a little different to some of the European markets where Aldi has been more successful because we are very geographically, what's the right word? It's a big country.
Yeah.
Okay. And it's a hard market to expand into to get huge penetration. So that's one of the problems that Aldi's face in particular is, of course, all the vet spots and all the big supermarket in big, you know, Westfields and those places are already gone. Right? Yeah. And that's pretty important.
And Aldi tends to be a limited offer. For those people who want to go to one stop and get everything, Woolworths and Coles, you know, shoot the lights out on that concept.
One of the stories floating around this morning was that Aldi's going to move into fresh food or fresh produce. So, look, I'm not sure that's where the best place to invest is in the consumer staple sector.
It's a part of a 20 stock portfolio.
Okay, let's go to Silvano, who's got a question on Slater and Gordon.
Silvano, are you there? No, I don't think people are at their computers today.
We're having a challenge today, but I hope you're still there, Silvano. So
some people are stage scared. I don't understand that. I think you're frightened. People force me to go on TV.
I think you're frightened away, Peter. What's your view on Slater and Gordon? Would you buy at these levels? It's a stock that's done super well.
Yeah. I don't know enough about the specifics about the company, apart from the fact that I think it's Jeff Wilson likes them. A number of the experts on my show like them. I asked the question, but hang on, they've run pretty hard, and they are taking on new markets overseas.
Yep.
And the answer was, yep, and that's why we like them. So, well, what's the chart look like?
Well, it's one way direction. Look, I suppose I would be cautious. The brokers all like them, so according to FN Arena, the consensus is $8.08 compared to about $7.20 odd roughly today. A ranking of 1, so everyone's got a strong buy on it.
Yeah, I have. Yeah.
So look, I'd get a little bit nervous.
Let's show the dividend, Paul. What kind of yield?
It yields about 1.4%.
Yeah, so
its P/E ratio for services business is about 20. I mean, yeah, this is getting a bit tough.
Yeah, I think they're a better one.
Look, I miss Slater and Gordon. I have to admit that. Australian track record of companies running businesses offshore is against them. For me, I'd say I missed it and let that one go through to the keeper.
I don't think they'll become ransom.
I don't think so in that case. Okay, let's go to Joe. She's got a question about the good dividend flows. Hopefully we're all successful in this one.
See if we can get Joe Ryan on the line. Joe Ryan.
Just when you mentioned earlier about a defensive portfolio, you mentioned about some good dividend payers and defensive stocks. I was just wondering if you had any examples, please.
Good on you, Joe, for getting on the mic and talking too. Fantastic.
That's right.
Okay, good dividend payers. Well, I've been actually, trying to strangle my expert buddies on the show. And one interesting one last night, which I could almost do as well. I quite like Woodside. I do think oil prices will sneak up. And so that's an interesting dividend stock. Paul, you got one to try?
Well, look, I mean, obviously Telstra's probably one of the key dividend payers. I'd say a reasonably defensive stock. I don't like Medibank, but a lot of people do like Medibank. It would be in that category, and you probably could look at someone like NBH in the same category, so they're fairly defensive. You could argue that the consumer staples we just talked about, Woolworths is probably a reasonably defensive stock. I think also that things like ATL in the utility side, some of the others in that area, obviously the property trusts are defensive stocks. The
What Challenger, Paul? What's this doing like?
I don't think Challenger would be in that category. Woodside, I think, is certainly in that category as a dividend payer. Even BHP. If you saw my article,
yes,
a brilliant article I think there the other day on,
best article I've ever read.
BHP, the yield stock. BHP is going to yield close to 5% this year. And if you read what the directors have said, they're actually committed not to paying dividends.
Yeah.
So, you know,
I was quite surprised last night that Roger Montgomery said that he likes Bendigo. Now, Bendigo would probably be yielding 5% or so too, wouldn't it, Paul?
Yeah, so some of the banks have all got a little bit of a question mark around capital, but they're some of the questions on stocks in that category. Does that cover your question? Oh, she's gone. Okay.
But Joe, if you do get a chance to watch my television show or go to our website, I am going to keep pushing my experts for dividend stocks that we don't necessarily always talk about.
Okay, we just talked about Woodside. We're just running out of time, Peter, so we'll try to deal with those. Let's try Helen. See if we can give her a question on Woodside.
Around webinar.
Helen Gilbert, are you there?
Yes, I am. Can you hear me?
Loud and clear. Ask away.
Well, you've just spoken about Woodside. I know the price has been tracking downwards, but is it worthwhile putting some more funds into it on yield basis? I have a self-managed super fund. Yeah.
Do you have a big exposure to it?
No, less than 20,000 at the moment. Probably about $18,000 worth.
Yeah. As I say, a lot of people I respect do like Woodside, even for the yield. But I know Michael McCarthy said to me last night, he likes Woodside. I said, but you must have the view that you think the oil price is going to go up. And he said, that is definitely my position. So the only rider would be, there are some bears out there who tip that the oil price could go to $20. I don't think that's going to happen.
It probably depends on how much the US keep flooding the market.
Yeah, I also think OPEC wouldn't permit oil prices to fall that amount because they're playing a game a bit like BHP and Rio in the sense that they're flooding the supply and allowing the price to fall. So I think Woodside is a reasonable play at these levels.
Yep, I think the Woodside is probably a bit of a yield stock, and look, I wouldn't be rushing to buy it, but you know, again, it's probably in my dip area. It's one of the stocks I would look at. I'm actually going to look at Santos, but maybe a bit early.
Yeah.
But I don't like the whole CSG stuff. But I think Santos is really on the nose. I'm going to have a look.
It's got some good assets.
It's got some good assets. Okay, let's go to. Another question about Rio. So is that John? If we get John?
Yep, John Thornton, we're coming to you. John, are you there? No, he doesn't appear to be listening.
What's the question?
The question is from John, do you agree with today's Herald article that Rio will benefit from the ECB's QE that starts next week?
Well, I think when QE works and Europe grows faster, iron ore stocks, all commodities will go up. It's the nature of stronger economic growth that commodities will benefit. The question is, how long will it take? And so I would expect commodity prices to really spike until 2016, and that would be when the economic growth results from QE are actually surprising expectations. And I've got to throw this in. It took a couple of years, nearly 3 years, for the US to show that the QE program was working. And so it may well be longer. It might be 2017. But if you're a long-term investor, I think the answer is it will work eventually, but I'm not expecting quickly.
Well, yep. Okay, all right, we're just running out of time, so let's go to Sherviness. She's got a question about Altium.
Don't know.
Uh,
What is that? So you should
I don't know much about Altium. This maybe Sherviness can help us.
should rename stuff.
Switzer Super, are you there? Switzer? No, I don't think she's there. So,
Okay.
What have you got there?
I don't know much about Altium, so we'll move on, Peter. We've only got a couple of minutes left. Okay, so there's a question there from Victor. Let's try Victor back on yield again.
Victor Kwan, are you at your computer? He's also not there. So Victor's asked, any good companies with good yield that still have good upside to them?
That's a $50 question, isn't it?
Well, I think we covered it with the Joe Ryan. I thought we covered that too. Good yield stuff.
Yeah, well, where do you see upside though? I think that's the question. I mean,
well, the upside will come from Reserve Bank will probably cut interest rates again, which will help yield stocks. But I think there's only one more cut left out there. I think the economy is going to improve in the second half. So one more cut, that will help yield stocks, and then they'll probably go sideways.
yeah, I remember a lot of the yield stocks we've talked about are top 20, top 30, top 40 companies. So it's very hard for the market not to reprice without those stocks going high. I mean, Charlie, for example, loves or been very bullish about Telstra. Telstra's gone pretty quiet the last couple of 2 or 3 weeks. So there's, you know, he put a call on, I think, of $7 or $7.50 on Telstra. Yeah. And was it $7.50?
It was over 7. That's
over 7, and Telstra's had a bit of been a bit quiet. So there's probably a yield stock that I think is.
And I think it will go over 7.
Is probably a bit of a standout to look at.
Yep.
Look, the banks are doing okay. They'll sort of probably go with the market, maybe not be as strong. Have a look at my income portfolio. I don't really see much reason to change that at the moment.
That's done well.
And you know, I'm still reasonably comfortable with, but probably looking in a new money sense, waiting for the market to pull back a bit. Okay, we had a question from Mark about pharmaceutical companies.
Mark, we're coming to you. Mark Lucina, are you at your computer?
Can you hear me?
Yeah.
Hello?
Loud and clear. Ask away.
Yeah, look, I just wanted to know if you guys had any thoughts on Clinuvel, if you've got any guidance on that company.
Don't know it. But I will pursue it this week. Clinuvel, is it?
Yes. Small pharma company.
What's his ticker code?
CUV.
CUV.
I'm sorry, Mark, I can't help you on that one, but...
No worries, I thought I'd just ask the question.
Yeah.
No, I'll chase it up this week on my TV show, mate. I always like to do that.
Who's your expert on pharmaceutical companies that comes in?
Yeah, the guy who was Bill Potter is now...
is he due back on the show?
He's due back on the show. Yeah, I actually got my producer to chase him up. So we'll check Clinuvel out for you on the show.
Okay, thanks a lot. Thank you.
Mate.
All right, I think we've got one last question because we want to finish here at 1:30, just so that we have people need to go. It's John's. Another tough one.
What's this one?
This is about Godfrey's.
So John Hopkins has asked, what are your thoughts on Godfrey's?
Just stick me unmute, John. If there, it might be
We'll see if he's there. John Hopkins. John Hopkins, are you there? No, he's not. Not in the computer.
Okay, Peter, any thoughts on Godfrey's?
I think Godfrey's, I don't have a committed view. I think it's a very challenging market. They have lots of rivals out there. I think the arrival of Dyson has made Godfrey's a much tougher business because, they used to sell bags. But I've got to say, it's not the sort of company I'll be chasing.
Yeah, I've only got one analyst on Godfrey's. It's obviously in microcap. Credit Suisse rated as an outperform, which is pretty high.
That's good.
That's the top rating. They've got a target of $3.70 on the stock, which is about not too much ways from the moment. They thought the interim report last week was okay, basically in line with expectations. So look, that's their thoughts. I
I'll chase up on the show for you.
Again, these micro, what I describe as small cap, you've really got to get someone who studies them very closely.
Yeah. Did you say that was UBS or Credit Suisse?
Credit Suisse has got an out.
I might try to get the analyst on the show.
That's probably just better than insights than we can provide.
Yeah.
Okay. And then the last question from Sherman is, hold Santos or sell? I wouldn't be a seller at the moment.
I'm a holder.
But I'm not ready to buy, A, for oil price, and B, I'm just a bit worried about this whole CSG stuff. I think I know if you don't live in Sydney or Brisbane, you may not be aware so much of the Alan Jones impact, but it's pretty big, and I don't think we've heard of the end of the whole CSG stuff, particularly given the Queensland election results, now an issue in the New South Wales election. I'm a little worried about some of these oil companies or major companies that got exposed to CSG. I wouldn't be surprised if there was a big write-off at some stage. So I'm not into selling them yet, but I'm not yet putting any hard-earned on the back of Santos.
If it drops, all right.
Yeah. So on the back of that, it's now $1.130. We said we would finish on 130. We know many of you got other commitments to get away to. Thank you very much for joining us. Thanks, Peter, for your insight today. You'll be back tomorrow with our regular Switzer Super Report. Or Saturday edition. You'll be able to tell us what's going on in the US overnight, whether that have an impact on our market, and look forward to reading that tomorrow.
Yeah. Super.
So thank you everyone for joining us, and have a great afternoon and a cricket investing week and whatever else comes after that. Thanks a lot.